So today we are starting the first topic of we are doing the topic from analyzing income statement or analysis of income statements. In that we are doing EPS. You already know what is EPS. EPS is nothing but earnings per share. What is the general way of finding out earnings per share? Of course, net income by outstanding shares. This is when only I have 10 outstanding shares and the net income of my company is $100. Each shareholder is getting $10. That is his basic EPS. But the topic is not as simple as what we understand. It is somewhat complex topic. So we will solve EPS today, and now I will write a formula in front of you so that you may understand. For calculation of EPS, the formula is IAC by, and so.
So your voice is getting stuck a little.
Can you hear me now?
It's
Hello.
clear. Now it's clear.
Is it clear? Okay. Yeah. Now what I'm writing in front of you is IAC by Vanso. Okay. Now what is this IAC and what is this Vanso? IAC is income able to.
They're still getting stuck.
Just common shareholders.
Sir,
I'm only taking equity or common. Yes.
so your voice is getting stuck.
Akila, can you hear my voice? Hello.
Hello.
Hello. Yeah,
Yes.
can you hear my voice?
Yes. Yes.
Is it clear?
Yes. It's clear.
Hello. Okay. Prithvi, you join again then. Maybe some disturbance from your side, maybe.
Okay, I'll try, sir. Okay.
Yeah. Whole divided by weighted average number of common shares outstanding. Just make a note of this formula. Okay. So now income available to common shareholders, what you should understand. See, very clear. Common shareholders or equity shareholders are those shareholders of the company who are the actual owners. After settling all the obligations, finally, whatever is left over belongs to equity shareholders. What are the obligations company has? Company has to settle all its expenses. Company has to pay interest to bondholders. Company has to pay taxes to government. Then finally company will earn net income, but this is not the final thing. Then again, preference dividends have to be deducted. After deducting preference dividends, you get income available to common shareholders. Okay. So in this also we are supposed to discuss two things. One is the preference shareholders are of two kinds. One is like there are many kinds of preference shareholders: participating preference shares, non-participating preference shares, convertible preference shares, non-convertible preference shares, and then you have redeemable preference shares, irredeemable preference shares. But these are not the ones which we are discussing about. We only want to discuss about two types of preference shares. Those are cumulative preference shares and non-cumulative preference shares. Okay. Now the point here is, see, cumulative preference shares are such kind of preference shares to whom dividends, if not given this year, will be given next year. So it is always understood that whether company declares the preference dividends to them or not, it is presumed to be earned by themselves. Okay. So now, so cumulative preference dividends is always understood that it is earned by these people, or the preference shareholders always earn their dividends because they have cumulative preference shares with them. The meaning here is, if they don't get dividends this year, if the company declares or not, doesn't matter, they will earn they will definitely earn next year, if not this year also. So because that is the nature of cumulative preference shares, whether dividends declared or not doesn't matter, they will definitely earn, not this year, next year. Okay. And non-cumulative preference shares are those shares for which if dividend is declared, then definitely have to be paid. Okay. Because they don't earn. So if it is declared, they will definitely earn. Now, so I'll write the points here clearly. So IAC, okay, net income less non-cumulative dividends declared whether or not paid, less cumulative preferred dividends, cumulative preferred dividends earned whether or not declared. Okay. So then, so I already discussed with you non-cumulative dividends, whether declared, non-cumulative dividends if declared has to be paid, then you have to subtract from net income, and cumulative preferred dividends declared or not, it is always presumed to be earned, so you have to deduct. Okay. Then the resultant figure what you're going to get is IAC, income available to common shareholders. Make a note of this. Then I will give you details about Vanso and we'll go for a question right now. Were you people able to hear my voice till now? Hello? Hello?
Yes, yes, sir.
Yeah, because it got muted. I think right now only it got muted. Okay.
It was mute for a while.
Yeah. There is a question in front of you. We will do this question and try to understand the things. See, Matthew Corporation has 100,000 common shares, par value $10, outstanding on January 1st. During 2010, the following share transactions take place. On April 1st, 10,000 shares were issued for $50. Matthew Corporation repurchases 24,000 shares to be held as treasury stock. Matthew carries out a 2-for-1 stock split. 15,000 shares were issued for $55 each on November 1st. So these are the times. On April 1st, 10,000 shares were issued. August 1, 24,000 shares were repurchased. October 1, 2-for-1 stock split has happened. November 1, 15,000 shares were issued. December 15, Matthew declares a 10% stock dividend. Okay. So now see, first we will start from here. Jan 1st, 100,000 shares are outstanding and they are outstanding 12 months out of 12 months. Okay, so the weighted average is this. You're giving time weighted average. And see, 2-for-1 stock split. That means every one stock will be split into two stocks. That is 2-for-1. One stock split into two stocks. 2-for-1. Okay. So we'll multiply with 2. Why multiply with 2? Because if one stock splits into two stocks, 1 lakh shares will be split into what? 2 lakh shares, right? Is it right? Yes. That's the reason we multiply with 2. And stock dividend, they have declared 10% December 15. So this also we need to give adjustment. Stock dividend is nothing but for every one share, they're going to give you 10% of the stock. That means into for every one share, if they are giving 10% of that, that means for 1 rupee, it's like 10 paisa. For $1, it's like 10 cents. So it will become 1.10. Okay. So that stock dividend also we are giving here the treatment, and then it becomes 2,20,000. And then 10,000 shares were issued from April 1st. From April 1st till December, it is 9 months, 9 out of 12 months. Again, stock split, stock dividend. Why I'm giving these treatments? I'm giving retrospective effect as if all this happened from the beginning of the year, because this makes the things more compatible and easy to calculate. Standards say this. Then Matthew company repurchases 24,000 shares. Okay, see, already there are some shares outstanding, right? Out of those outstanding shares, the company wants to repurchase its own shares. So 24,000 shares it will repurchase. See, when the company repurchases the shares, those shares will not be outstanding for the remaining time. We are finding out outstanding shares. We don't want that data here, which is not outstanding. So we will remove this till from the time period when they are not outstanding, so that we can get only the outstanding shares. So see, this 24,000 shares which company is repurchasing are already outstanding from Jan 1st and April 1st. From that only we are repurchasing. So they will not be outstanding for how many months? 5 months now onwards. So we'll remove how much is not outstanding. So automatically what are outstanding are a part of the outstanding shares. Again, we need to give treatment of stock dividend and stock split for the compatibility. So again, I removed the number of shares which will not be outstanding, because we are finding out outstanding shares, and what are not outstanding are removed. That means some part are already outstanding from the beginning. Then 15,000 shares on November 1st were issued, and those are outstanding for 2 months out of 12 months. So we have calculated, and we will give only stock dividend treatment here, because 15,000 shares which were issued on November 1st are after the stock split dates. So after this event, they have issued the shares. So this will not be applicable to this, but this will be applicable to this. Why? Because we give retrospective. For retrospective, from the beginning we have to come. This itself is like before this beginning. Okay. So 1.1 here and 2,750 is your weighted average number of common shares which are outstanding, and when we do the sum total of all this, we get Manso. So please go to this again. I'll give you 2 minutes of time. We'll move forward. Any doubts, please ask me. Okay. Shall we move forward? Yes. So now we'll do a question and we'll understand how to calculate the, Vanso. Please do this question. I'm giving you time. I want you to solve. They're asking you to calculate basic EPS fast. Do this question fast.
Sir, done.
Okay. So Redford's capital structure at the at December 31st, 2001 was as follows. 100,000 shares of common stock issued and outstanding. So this is, from the beginning. 20,000 non-convertible preferred share dividends issued and outstanding, which are giving how much dividends? 20,000 shares, $2 per share dividend. So it becomes 40,000. So out of this, what is the income we have? 7,80,000. We will remove the preference dividends of 40,000 divided by Vanso, whereby we'll take 1 lakh into 12 upon 12. And do they have anything else to adjust? Yeah, there is a stock dividend of 1 point of 10%, 1.10 will do, which they have already done. So 1 lakh into 1.1, it becomes 1 lakh 10,000. And then you have the numerator thing. And then the EPS would be how much? 6.73. Did you get the 6.73 figure?
6.72.
Yes.
Sir, one doubt, sir.
Yes.
There they said on July 1st, Redford paid a cash dividend of $2 per share.
Yes.
So it is for the 20,000 non-convertible, not 20,000 into 2.
Yeah, that is on preferred stock.
But that is on July 1st, no? So should we calculate 20,000, sorry,
No,
20,000
no,
into
no,
2
no.
into
See,
6
see.
by 12?
No, 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 no. This is not this one what you are asking me. The preference dividends is only applicable for the numerator thing, not for denominator. In denominator, you are finding out weighted average number of shares.
Okay.
Understood?
Okay. So you should
When you
not.
are finding out weighted average number of common shares outstanding, where is preference share going to come? Nowhere. Only it is going to come here.
Numerator.
Do the next question. Do the calculation of Vanso here fast.
One lakh 5,000. No, yeah, 1 lakh.
How do we create?
Sir, 1,05,000.
Yeah, so 100,000 shares of common stock and outstanding from the beginning of the year. 20,000 non-convertible preference shares issued and outstanding, not at all relevant. $2 we have to subtract from 7 lakh 80 minus 40 to find out the IAC, but they are only asking Vanso, right? And
Yes.
here 1.10 we will take because 10% stock dividend.
No, sir, no, they're not. Instead of issuing 10%, they're taking 10,000 new
So
shares.
not, we should not do. Okay, very good. So what they did is instead of issuing 10% stock dividends common stock, as was done on in example when Redford issued and sold 10,000 new shares. So
So into
10,000 new
10,000
shares from
into
July
6.
1st, 6
Yeah,
months. Okay.
5,000.
So here it will be 1 lakh 5,000. 1,05,000, and then IAC is the net income minus preference units divided by Vanso. You will get your EPS. Okay, please check it out. If any doubts, you can ask me. We'll go further.
Sir, down they gave that like EPS was higher in the second one, no? So why that explanation? I didn't understand why.
When shares were sold rather than distributed as stock dividend, as was done in example 1, Vanso was lower and resulting BEPS was higher. See what happened is stock dividend was given, right?
Yes.
When shares were sold rather than distributed as stock dividend. See what happens when stock dividend is there, more number of shares will increase. Okay, as you can see the denominator there. What's the denominator here? 1,10,000.
Uh,
When the outstanding shares are more, it will be the EPS will be less, right? Here the
okay.
outstanding shares are less by
Yes.
5,000, so EPS is more. That's it. Just a second. Yeah. So let's move forward. Let's do a question from the text. Okay. Solve this question, please. So Johnson Company has 10,000 shares outstanding at the beginning of the year. So 10,000 into 12 by 12. April 1, and then see we have to see 10% stock dividend into 1.10. That is on July 1st. And then 4,000 new shares from April 1st. 4,000 into 9 upon 12 into 1.10. And then September 1, Johnson repurchases 3,000 shares. So this 3,000
minus
into, yeah, 3 September 1st, right? September, October, November, December into 4
4
by
by
12 to 1.10. You have to subtract. Okay. So you can see what's the answer coming, Prithvi? Tell me. We will not go down. We'll see from here.
for this also you should multiply 1.1
I
because
think we should not. Why?
three
Yeah. Why? No, no, no. Just a second. September 1 repurchase, right? July 1st, the stock dividend
uh,
was there.
stock dividend July 1st last.
For this, we should not do. Why? Because after that only the repurchase thing happened. Sorry. Yeah.
Yeah, if it was before July, we should
Yeah, yeah.
have.
Before July, 100% would have given the effect. But what has happened is repurchase happened after this event, right?
Yeah,
After the stock dividend has happened, the repurchase happened after that. Okay. But if
14.
repurchase would have happened in the month of April, you would have given
Yeah,
the treatment. Did you
yes,
understand?
yes.
In the previous question, what we did
14,300
in the
minus 1,000.
just a second. In the previous
Yes.
question, what we did, the stock dividend was issued afterwards. I'll just show you. Stock dividend December 15, applicable for everything. Okay, but split not after this. So once this, after this event, whatever comes, this will not be applicable because retrospective effect should be given. This 10% is only applicable from the beginning of the year, only before what the before this any event has happened. But how come I can give retrospective effect of 10% to September 1? I can't give, right? When this has happened in the month of July, correct or wrong? Yes.
Yes.
That's what retrospective means, as if things happened from the beginning. This thing on July 1st happened before September. So this is applicable from the beginning. After this, after stock dividend declaration, the stocks were repurchased. So we won't give. So when you do the calculation,
13.
is that what we got?
Yes, the
Yes,
14,300 minus 1,000.
13,300. Okay, done. Now can you do this EPS question, please, fast? I assume you are doing right. Okay.
So it's the same company.
Yeah, Johnson Company. Yeah.
So we should take that
Same
van.
company. One part of this is done, man. So you have to do only the IAC
Okay,
numerator
so we
part.
should, that's what I was saying. Where is van? So we should not. We didn't calculate. 0.67.
Yeah.
So,
So now, yeah. So 10,000 is the net income. Cash dividend paid to its preferred shareholders.
minus.
So we don't take this. So minus this basic, and this is Vanso. So your EPS is 0.68. Done. Next. So next concept is diluted EPS. It will take time for us to do, but we'll no problem. We'll kind of do the introduction part at least. What is diluted EPS? I'll explain you first. Yeah. See, diluted EPS is nothing but the dilution of EPS. What is dilution of EPS? You were getting higher, income previously when the number of shares were less, but when the number of shares increase, you'll get less earnings in your hands. How? Let's say there are just a second. Let's say I just calculate the net income out by outstanding shares is my EPS. Net income is, let's say, $100. Outstanding shares are 10 shares. So each one is getting $10. But now let's say $100 is my net income and there are 20 shareholders in my company. So each one will get $5. There is a dilution of EPS or not? Yes. The dilution of EPS has happened because of what? Number of shares increasing in the company. So when outstanding shares increase, people get less income now. There is a dilution of EPS. Okay. And when outstanding shares are Vanso, increase, there is a dilution of EPS. Fine. So this is the case here. So why will this, but what are the reason for the Vanso increasing in the denominator? The reasons can be extra shares issued for additional capital. Second reason can be convertible preference shares converted into equity. Third reason can be convertible bonds converted into equity. So this all will convert into equity shares and number of equity shares will increase. Fourth reason can be options and warrants exercised. So let's say a company's employee or like a top executive of the company has been given the option to buy company shares in the future. Okay, that is called ESOP, employee stock option plan. And if he exercises that option and buys company's shares, the number of outstanding shares will increase and that will again dilute the EPS. So these are the reasons. Fine. Let us understand a small question here with which we will try to finish this topic today, giving you what is the meaning of diluted EPS. So please focus here. Kelly Corporation had a net income of $1 million for the year just passed, and the company had 500,000 common shares outstanding throughout the period. So if I want to calculate the basic EPS, I'll take the income available to common shareholders calculation. I'll take net income. I will subtract the preferred dividends. Let us calculate that. 7,500 shares. Here you can see convertible non-cumulative preferred dividends paying 4%. So we'll calculate the dollar amount. 7,500 shares into $100, $7,50,000 into 4%. That is $30,000. Okay. So 7,500 shares into $100 will make it $7,50,000, and $7,50,000 into 4% will give you $30,000 as the dividends. Okay. And that dividend we will subtract here. Okay. So like 10 lakhs minus 30,000, 9 lakh 70, divide by 5 lakh common shares, 1.94 is your basic EPS. But what is happening? During the previous year, Kelly granted options to its president. So this is what Kelly has done. They have granted options to their president to purchase 30,000 common shares at a price of $10. It's a very good option, right? Given to the director of the company. So now, if he has to consider this option, he will check what is the price going in the market. So on Jan 1st, the price was $22. 31st December, the price of the stock was $30, and the average price is $27. Seen here. So something which can be something which is trading at 27 and offered at $10, definitely it's a good deal. So the president will definitely exercise this option. So company will sell the shares to the president, and president will make the payment. How much? 30,000 into $10. Okay. So that will be $3 lakh. Okay. And what the company is doing is, after collecting those $3 lakh from the president, they are buying back their own shares. Okay. With this entire amount. So what happens? We will see the number of shares what they can buy. So 3 lakhs divided by average price 27. So they can buy how much? 11,111 shares. So 30,000 shares issued and 11,111 purchased or bought back. So how much are still outstanding? 18,889. Now, the income available to common shareholders was how much? 9 lakh 70. 5 lakh shares were already outstanding. Now still outstanding is how much? 18,889. Because of the number of shares increasing in the denominator, because of the number of shares increasing in the denominator from 5 lakhs to 5 lakh 18,889, you see the EPS has got diluted. Previously the EPS was 1.94, now the EPS is 1.87. Okay, so with this we see that the EPS has got diluted because of the Vanso increasing in the denominator, and the reason you know. Okay, so let's hello. Yes,
so one doubt actually.
yes.
So here they repurchase the stocks at $27.
Yes, they will be repurchasing at the market price only. If
So
someone
market,
wants to, just a second. See, if someone has to purchase from you, you will be quoting market price to them or not.
but here it's average price, no, it's not market
So
price.
that's what, who told you that is market price? I didn't say the price at the beginning was this, at the end of the year was this. Did they mention you when did they purchase during the year?
No.
Did they
So
did
you
they say
should
you? Hello?
no, they didn't tell
That's
me.
what. Then you will take average price.
Okay.
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 Yeah, let's connect on Monday then. Thank you.
Okay. Bye.